All right, welcome everyone to another edition of Give Me Some Truth International. Dis-moi la vérité. I won't attempt the Portuguese version of our podcast title this time, because I think last time we did it, we got comments on YouTube from Portuguese speakers about our pronunciation. So I will not offend anyone. Maybe you can attempt it, but I don't know. I won't. If you want to try it.
Perdão. Desculpa.
So,
por favor. Grande porcaria. Which is my way of saying, who cares?
Okay, right. So let's move on. I'm Syl Michelin. I'm joined by Stan Farmer here today. This is part of our, a series of podcasts that we are doing about our investment outlook 2024. So looking forward to a discussion with Stan here about his piece. And I think you wrote about international investing, international stocks.
Yes.
But from kind of a
behavioral finance kind of
kind of an interesting angle. You surprised me a bit with that angle. I didn't know you were such a big behavioral finance type of guy.
First of all, it's good to know that I can still surprise you, even after all these years. You're surprised by surprise.
You surprised me.
Which is hard to believe.
Almost every day with just the shoes you wear. And
So our outlook for 2024, first of all, was a we gave it a theme of Back to the Future, right? So that's why today I'm wearing the puffer vest.
I like the puffer vest
and some retro Nikes.
Okay, that explains the shoes. Okay,
let's go back.
Now I got an explanation about both. I appreciate it.
And what I might have been wearing to Washington Senior High School at Cedar Rapids, just like Marty was going to Hill Valley High. Did not have a Toyota 4x4,
no?
But I would have thought it was pretty boss too.
Okay.
I think I had a Bronco 2, which is kind of Anyway. It's back.
It's
See?
back. So
Back to the Future. Here we are with Broncos again.
So in your piece, so you make some interesting points, and the main theme has to do with this idea of recency bias.
Yeah.
So what's recency bias?
Okay. So recently, it's been a very patriotic move in global markets, right? It's been very USA all the way. And I've done pieces before to make the case for international stocks, but it occurs to me now, after we're now 15 years into the recovery from the Great Recession, right?
Mm-hmm.
And it's been a very pro-U.S. move,
That's right.
pretty much all the way.
Mm-hmm.
Okay, maybe a month or two, not, but it's been pretty consistently, USA stocks have dramatically outperformed foreign markets, both developed and emerging, right?
Mm-hmm.
So there is so much programming in our investment genetics, in our day-to-day genetics. When we think about investing, we need to be forward-looking, right?
Yeah.
We need to avoid forward-looking statements because, apparently regulators don't want us to give them. But really, investing isn't about, you don't get the returns from, the previous 15 years when you invest in a
Past
all
performance
USA
is
portfolio.
no guarantee of future results.
No truer words have ever been demanded from a regulator. So to me, there are lots of economic reasons. There's we could talk about valuations.
Mm-hmm.
We could talk about the price to GDP ratio of the S&P 500. We could come up with lots of statistics to bore you with, but none of them are going to change behaviors in terms of the way most people are going to invest now, right? Because we could talk about currency and how the dollar has dominated this period,
Sure.
and how that, that may, have reached its limits, or maybe soon to reach its limit, and these trends tend to reverse. We could talk about mean reversion in an intellectual way, but none of that matters if we don't first acknowledge that we're all programmed with this overwhelming urge to project into the future based upon mostly what's happening now
Yep.
and what's happened recently,
Mm-hmm.
right? So we go to the Back to the Future movie, for example, and then we go to Back to the Future Part 2, where at the end of Part 1, they tease you about going into the future and what's it going to look like.
Right.
That's 1985, and then they go in the future to 2015, which now is, the past
Right.
for us. And when we look at the movie, and I encourage you to revisit that movie with your kids, with your significant other. They're fun, but there's also some messages in those. But it's interesting to see what an 80s film director, Spielberg and company. I think Spielberg directed the second one, but I know he did the first. But anyway, how they envisioned what 30 years into the future would look like.
Right.
And now we can look at it from the lens of, well, we know what 2015 looked like.
Right.
And it was very, it had a very 80s varnish to it, right? So, I mean, in the 80s we had, Velcro laces and the Reebok pump.
Yeah.
Right?
I love the Reebok.
And then in the 2015 version, it was almost like Velcro laces, but it was like a battery operated, like self-tightening Nike, right?
Mm-hmm.
And the movie playing at the downtown cinema was Jaws 19. Right? So, which I think was kind of a little spoof on Spielberg,
Right.
but the principle is there that we're so tethered
Mm-hmm.
to the recent past and the present,
Right.
that we're going to project more of the same.
Right.
And that's recency bias. It is one of the most it is one of the most dangerous biases because it's so powerful.
Yes. And it has such a huge impact on investment thinking. And not just with, kind of day traders, but really all investors.
We all have
Right.
it.
We all
right?
have it.
It's
We feel it.
It's not a pandemic that you might get it and it goes away, or or it comes back once in a while. We innately we're born with it, and
Right.
and we have to acknowledge it, and then try to intellectually
Mm-hmm.
figure out how to somewhat overcome it.
Right. And so in practice, an example of recency bias would be an investor thinking, well, look, U.S. stocks have done the best recently, therefore I'm going to invest only in U.S. stocks. And one point that you make in your article is that, what's interesting is this recency bias is also compounded by another bias that investors tend to have, and that's home bias. So what's home bias?
Yeah, home bias. So really, there are two powerful forces right now that are at play that make it difficult, that make the case for international investing unpalatable to most. Right? Home bias is simply the concept that we're going to put our money on things. We're more comfortable putting them on what we know, right?
Mm-hmm.
Even if what we know, sometimes, would imply that we also know that there's, challenges, right? But we're comfortable with it because we understand it, right? This could go from, back to the age of Peter Lynch of Fidelity fame, saying, hey, invest in the products that you really like.
Right.
Invest in the companies that make those, invest in things that you can, see with your own eye, and, and so on. And so, investing in Microsoft when everybody used Windows, right? As opposed to, investing in, maybe well, I mean, there's no real equivalent to Microsoft out there, but investing in a company, say in Japan or China, that you're really you're not necessarily as comfortable with maybe the governance structure or
Right.
the accounting
Sure.
or whatever, right?
Yeah.
So I mean that's always going to be part of the investing scheme, and I think that really rings true now, right? Because
Mhm.
when 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 you hear the pundits who are perpetually wrong about many things, but the people who get paid to go on television to offer their opinions, if you mention anything China, right, then
Right.
immediately they're going to say, well, I mean, not sure it's investable because
Right.
of the political tension between the United States and China, and
Mhm.
and all the things that their economy is going through, and
Right.
like it it's always going to feel safer to invest in USA,
Sure.
right?
Sure. And it's funny you use this word investable, and it kind of reminds me. I remember, I think it was back in 2021. I was reading a piece by Goring and Rosenzweig, who are an asset manager specializing in raw materials and energy, and they wrote a piece back then that was called "Investing in the Uninvestable," and it was a bullish case for oil and gas, for energy at the time. When you remember during COVID, when oil went to zero, I mean, who would have invested in that, right? It was
Right.
the definition of something that was uninvestable. And if you add the other many reasons why oil and gas you may question its future, it really was a textbook example of something that was at the time completely uninvestable. Yeah, if you look at the charts, had you invested in that back then, that would be one of the very few ways that you would have actually done better than even tech and the NASDAQ
How about
and
that,
everything
right?
else, right? So it's kind of sometimes they're, the most attractive investments are the ones that look and feel uninvestable at
Right.
any particular point in time. But it's
So objectively, buy low, sell high.
right.
Don't
Easier said than
buy
done.
high and hope for higher.
Exactly.
But so the objective, economist within all of us knows this is true.
Right.
If we go shopping at two different stores, and we're buying the same product, we want to buy the one that's on sale, right?
Exactly.
Right? But recency bias is so powerful
Mm-hmm.
that it trumps our own
Right.
basic common sense
Right.
sometimes, right?
Exactly. And another point you make in the article is that really, I mean, one of the ways to overcome recency bias is to zoom out a little bit and consider longer time frames. And really,
Right.
I think you show some examples in your article that if you're really a long-term investor, long-term thinker, you don't even need to go back really that far to
Yeah.
find instances of, the U.S. not being so dominant in the
Right.
stock market.
Or the U.S. being dominant and then suddenly not,
Right.
right? So and let's go back to the Future.
Mhm. Always. That's
Right?
the theme.
85 to through the 90s, right?
Mhm.
I mean, there were some there were some bumps in the road, right? There was what was the company Capital that went under? The hedge fund,
Long-term
long-term
capital
capital,
management.
right?
Yeah.
Things like that. There were shocks. There was a Fed chair that called the move in the 90s irrational exuberance,
Right.
right? But that didn't stop because recency bias is sucks at the womb at the teat of irrational exuberance,
Right.
right? That's
Well-
fuel to feed the flux capacitor of, sorry for all the Back to Future analogies, but that is that feeds the flux capacitor of recency bias.
Well, I
right?
mean, so the first
the more exuberance there is, the better.
So the first Back to the Future movie, and I had to remind myself of this, came out in 1985, and I think the second one, 1989, and
Yes.
that coincides almost perfectly with one of the absolute, greatest, best example of a country specific asset price bubble that we've ever seen, right? And
Are you feeling Japanese?
that's the Japanese
really feeling
asset price
Japanese?
bubble of the
You really
of
think
the,
so?
of the 1980s, which I'm not saying is being repeated today. I don't think we are in anything resembling that level of craziness, but nonetheless, I think it's helpful to think about extreme examples.
Hey, you know
right?
what? It's an interesting one, right? Because the perception, we both can remember that period of time. The perception is that Japan's the home of innovation,
Right.
right? They do it better, smaller, faster.
Right.
Build the best Walkman.
And look,
For God's sakes.
so Japanese stocks right now are, I think, about 5 or 6% of global market capitalization. Back in '89, so at the peak of the
Peak of
asset
the
price
Nikkei.
bubble, I think they were north of 40%. I think 42%.
Yeah.
Now,
that's
can you imagine
amazing?
a stock market where globally, where Japan is 42% of market
I
capitalization?
don't know. What's California right now?
I mean, that feels pretty crazy. And yet at the time, had you been overweight Japan, you would have looked like the smartest guy in the world. And, had you been inclined to, follow your recency bias, you're thinking, you may have gone all in on Japanese assets. And what's funny is just, it was not just a stock market bubble. It was also a real estate bubble. And
Right, of course.
And at the time you could, it was justified by very simplistic thinking, like, look, it's an island, like, supply is so constrained, like, it cannot go
Yes.
down. It's
Well, and the wealth effect of, people who had ownership in their
Right.
company stock, right?
Yeah, exactly. So it's kind of self-compounding, and at some point, it's ridiculous in hindsight, but yet people weren't seeing it at the time. And so I think it's helpful to kind of remind yourself of these kind of extreme examples. And even though I don't think we're in a Japan situation right now, it's a good reminder of why we want to stay diversified,
Right.
and why
There-
we
there-
don't.
I mean, the point is there's no historical precedent for outperformance forever, right?
Right.
It always ends,
It does.
and oftentimes it ends badly.
Yeah.
I think it's fair to say, right?
Right. I mean, there's always, I think people tend to think, well, look, if the environment changes, we'll just make adjustments as we go. But that's not how it works in the real world. You
No.
don't get to make adjustments. It's by the time you see it, it's already too late.
I mean, recency bias, can persist and get us to tell ourselves that well, this is just a bump in the road on
Right.
the way to more.
Right. Exactly. That's what you would think.
It's a healthy pullback.
Yeah. Exactly. By the dip. So
By the dip and the rip.
I think, going back to your point about like Back to the Future, and like, it's true that they didn't see things like 2015 being all about the internet.
No,
They
nothing
thought it'd
the
be
internet.
about, say, self-lacing shoes and stuff like that, right? It
And
a
flying
direct-
cars.
Flying cars.
Flying cars that were apparently still fueled by Texaco,
Right.
a company that no longer exists because it was bought
Yeah.
by Chevron. But that's beside the point, right?
And look, so, in statistics, there's what they call a change of regime, right? There are times when you enter a different regime where the old rules no longer apply, and you don't see it coming. It just creates a shift in the environment where everything is different. And back in 1989, they perhaps didn't see that the internet was going to result in a complete change of regime, and everything would be different. So, the same thing happens in investing. We're in a particular regime now, but things can change, and, the next 10 years may not look like the previous 10 years at all. So it's important to keep that long-term perspective in mind. And I think
Right.
it's a big part of, why we invest the way we do, and why we try to not just be blindly following trends.
Yeah. So I mean, the recency bias case of today, obviously, is fueled by enthusiasm for AI, the companies that have now been coined the Magnificent Seven, right? Which are the dawn of the $1 trillion market cap stock, right?
Yeah.
And now even I think the first to hit the trillion mark was just a couple of years ago, right? And then now maybe 4 or 5 years ago, but now some of those stocks have hit 3.
Yeah.
Just insane, right? It took the stock market in the United States 200 years to get to a trillion for a company to reach that trillion. It hit 3 before you know it,
Right.
So over the last 5 years, concluding at the end of last year, you had a situation where the S&P 500, despite the fact that we had a bear market in the middle of that 5-year period, right? Still, the S&P 500 returned over 88%. The NASDAQ 100, which is a more concentrated version if you want those Mag 7 stocks, right? 162%. And Vanguard Infotech, which would be like a more sector play that's going to encompass a lot of the Magnificent Seven, but not all of them, right? 192% in 5 years. Okay, outstanding, right? Who doesn't want to own more of that? Right? Winners win. That's what That's what recency bias is whispering in your ear every day, right? How did the international how did the main international ETFs fare compared to that? Well, I mean, so I just handpicked 3 of the more common benchmarks, if you will, right? You've got the most popular ETFs. You got the Vanguard Total World International Stock Market, right? Total International did 20.4% in that 5 years. Positive, but over a 5-year period, that's a compounded return of what you could get in the short term, money market now, right? Vanguard Developed Market, FTSE Developed Markets, which would be Developed World ex-US, right? Fared better, 26.5% roughly return. Still, pretty subdued. Obviously, a quarter of the return that you would have gotten in the S&P. Emerging markets, right? The iShares Emerging Markets ETF, 1.3%, folks. You could just basically say flat, right?
Yeah.
Flat. What the market might do in one day.
Dead money.
It took 5 years.
Uninvestable.
Uninvestable. That's what recency bias is also whispering in your ear when you when you look at that kind of comparison, all right?
Right.
Now, again, trends can persist longer than they're rational. Can have irrational exuberance. Let's go back to the 90s and irrational exuberance. The USA markets clearly outperformed. It was the internet boom, and most of the big internet stocks were made in the USA, right? So, and that didn't change, right? I mean, the internet continued to grow and grow, so stocks must have continued to do well forever, right? No, right? So we get through the 90s, and then, we have the tech crash 2000. And then we have, a little dark period there. If we go back 20 years into the past, look at 2003, for example.
Right.
We're coming out of a bear market. U.S. stocks did all right, but were they dominant? No. I mean, so over a 5-year period from 2003 to 2007, right? Emerging markets, number 1 performer by far.
Yeah.
Developed world ex-US, second place of all asset classes by far.
Okay.
Really well. And the U.S. got a return over that 5-year period that would have looked like, what international markets have done over the last 5 years.
And I remember that.
Very ho-hum.
I remember that period of time. The big narrative at the time about emerging market had to do with decoupling. And there's this whole idea of decoupling is like the market and the world was being split in, low growth developed markets versus the high growth
too big to grow
emerging markets.
Yeah.
And that's where the future was. And if you think
aging populations versus
all that stuff,
yeah,
right? And if you think about, the decoupling era versus where we are now, it is so different. And it's kind of like, what happened to this whole decoupling idea? It's completely gone away. So another interesting...
As narratives do. That are written
right?
to, by your recency biased mind.
Exactly.
Right?
Exactly. So really, there's a lot of interesting example like this in your article, and I'd encourage everyone to read it. And again, we have this theme about Back to the Future, and it's always interesting to look at market history. And, one thing I mentioned in my article, for example, if you want to go back even further, you go back to the 1920s, and you have, one of the great stock market craze that was also fueled by excitement about new technologies. And, back then it wasn't NVIDIA, but, it was companies like RCA, the Radio Corporation of America. And, it had NVIDIA-like performance back then.
Motion picture, phonograph.
I mean, all that stuff was super exciting, right?
Yes.
It was changing the world, right? But again, things come and go. And, it did end in one of the most brutal crashes that we've ever seen. So again, without trying to make predictions or trying to say,
and we're not doing that, folks. We're not here today saying if you own U.S. stocks, you're a sucker and you're going to get killed.
Exactly.
Right? But we are entertaining the idea that there's some buy low opportunity out there.
Exactly.
If you can overcome recency bias, the case for international stocks is compelling.
Right. Exactly. I think the purpose of this discussion ultimately is to give some perspective, right, around everything that's happening, and remind people of, why there's probably still a case to be made for investing in things that aren't trendy, right?
Yes.
That aren't in the headlines every day.
Yeah. What's not working now is still something that you should own bits of, because diversification smooths out the ride. If you owned only American stocks, you would have made no money for an entire decade following the 90s.
Right.
The lost decade.
Mm-hmm.
I love the way they coin these things. So
right.
clever, right? You would have made money if you would have owned a diversified portfolio that included bonds and foreign stocks.
Right.
Right? And some real estate. You would have made good money.
Absolutely. And look, and as far as, the way that we tend to invest, fundamentally we tend to be very prudent investors. Right, we want to stay diversified, and I've said this to many clients. If you want to be a diversified investor, you're going to have to own things that you don't necessarily love. You're going to have to own things that you don't feel strongly about, and that's just part of diversification and risk mitigation. You may not see the case for that investment right now, but again, it's prudent.
Diversification also means you'll always underperform what's working now.
Exactly. Right? There's always something out there,
but you'll
that's
always
going to do better.
You'll always outperform that thing when it stops working.
Right. And which, goes back to long-term returns and risk-adjusted returns that are an important consideration, but probably a topic for a different podcast. And we're going to wrap this one up today. And I will just remind viewers to like and subscribe. Stan really insists on that, so I just...
Well, yeah, if you like this content, if you're interested in reading more of our outlook in 2024, you can go to our website at walknercondon.com. If you'd like us to send you a PDF of that, you could request it by emailing us at info@walknercondon.com.
Absolutely. Go check out the report. We all contributed to this, and there's a lot of really interesting articles in the guide, the Walkner Condon Guide 2024. And with that, we look forward to seeing you again soon for our next episode.
Thanks so much.
Thank you.
Bye now.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.
You gotta leave your money behind you. Raise your hand to the sky. Ask the masses for silence.